Welcome to this Killik Explains finance video. This week, the 3 key drivers of stock market returns. Big subject, going to compress it down and cover all the basics for those people who are not sure. Now, an overview, first of all, there are many factors that can affect the performance of stocks. However, most of them are reflected or captured in just 3. What are those 3? Well, first of all, we've got the dividend yield. Quick refresher on that coming up in a moment, and its contribution to total returns too. Number 2 is the rate of earnings growth. Number 3, often underestimated or forgotten in a few cases, the expansion or contraction of the PE ratio. Combine those and you get a real understanding as to what is driving total stock market returns. So, with no more ado, putting it all together then, if we were to take some Vanguard data from various decades going back from the 1960s through to what are called the 2010s, that's 2010 to where we are now, and break it down into dividend yield, growth and PE. So there are my 3 factors, number 1, number 2, number 3, we'll be revisiting those in just a moment. Let's just ignore those and look at the annual total return. So quite a bit of fluctuation there, around 7.6% from the US market on average, based on Vanguard data in the 1960s. Some chunky returns annually through the 80s and 90s, and then back down to more like 12-13% from 2010. Now, the numbers are there really purely for illustration. What's more interesting is what contribution did these 3 factors make to those total annual returns, and what conclusions do you therefore draw as an investor when looking ahead? Well, let's take that in turn. So the dividend yield first of all. So what contribution did dividend yields make on average to those total annual return numbers on the right-hand side? And here's your answer. Now, you'll notice something about these numbers straight away, hopefully straight away. They're reasonably steady, they're reasonably consistent, and as a percentage of the total, they're definitely not the full picture. But that doesn't mean you should overlook dividends, far from it. So, there's obviously more to know to get from there to there, and we'll find out what that is in just a moment, but let's take a quick look at dividend yields first. As a reminder, all right, this is a reminder, I've got a separate video purely on dividend yields, if you want to see that at the end. This is the annual dividend expressed as a percentage of the share price. All right, so it's a fairly simple, clean calculation. It's a key component of long-term equity total returns, not least of all because you can reinvest dividends, you don't necessarily have to take them out and spend them. All right, attractions, therefore, it's the most stable of the 3 factors. If we look back here, you will see stability in the left-hand column, which we're not going to see necessarily repeated in the middle and right-hand columns. So that's quite important. All right, and on top of that, it represents an actual rather than a paper return. And that's important too. Cash in hand, not expectation, if you like. And thirdly, it does encourage management discipline and a focus on cash flow generation. It's not foolproof. Firms can get it horribly wrong. They can try and sort of offer substitutes like scrip dividends and so on. But in principle, it does focus management on the job of generating enough cash to meet the dividend. So it is important. And what's more, although dividend income can be volatile, and the past is definitely no guarantee of future performance, if we were to look at a snapshot of, let's say, the UK market this time, the FTSE All-Share versus the annual income, annual dividend income from that basket of shares, if you like, you can see that broadly over time, with some fluctuations, the trend for some years now has been upward. And that in itself, some people interpret as being quite supportive to share prices going forward. Not going to promise that, but that is one way of interpreting that information. So, what else is in this mix? Earnings growth, that's the second component. Let's see what that adds into the mix. So we're aiming to explain the annual return figures out on the right, if you like, and this time we're adding into the mix earnings growth. Now, straight away, you can see this is, first of all, quite significant. Okay, if you were to take, the 1970s for argument's sake, 9.9% came from earnings growth. Now, the very fact that the annual return figure is quite a lot lower tells you something about what must have been going on in column 3. We'll come back to that in just a moment. You can see quite a significant component, but you can see something else as well. Quite a volatile component, particularly when we get down here. So, quick snapshot, quick refresher if you like. What drives share prices? Well, we're now into columns 2 and 3. So you could say, what's driven a share price from £1 to £1.20? You could argue there are 2 factors at play here. One, the one we're looking at now, earnings growth. The other, multiple expansion. Now, for anyone new to this stuff, here's what we're saying effectively. If we're saying it's all about earnings growth, then what we're saying in effect is if a PE multiple is 10, in other words, the market thinks it will take about 10 years to get your money back, ignore inflation and so on, if you buy the stock now, EPS is 10p, the share price is £1. Mechanically, those three are linked, so 10 times that equals that, if you like. So that all seems quite reasonable. But now what we're saying is this. The share price has moved to £1.20. The PE ratio hasn't changed. In other words, expectations haven't changed, but earnings have moved up to 12p. And that's what has changed mathematically or mechanically the share price. All right, because the formula basically says it has to be that way. So that's all about earnings growth. In other words, the movement in the share price is entirely down to earnings growth itself. Now, observations on this. Earnings are more subjective than dividends. This is the problem with leaning too heavily on that as a basis as a driver of future returns. Earnings are more subjective than dividends. They're not cash. All right. Earnings growth has historically been more volatile than dividends. We saw that just now in my summary snapshot table. We'll see it again in a moment. And earnings streams are harder to forecast on average than future dividends. All right. What I mean by that is companies go to a lot of trouble to protect dividends. They only cut them or substitute them if they absolutely have to, whereas forecasting future earnings is tough. So keep an eye on companies' success at meeting or beating earnings growth estimates. That's pretty important when it comes to judging where a share price might go in the future. Third, PE multiple expansion or contraction. So it's not all about the two things people think it's all about sometimes, dividends and or earnings. Some people think, well, that's it, that is the story when it comes to share prices. No, this is important too. Now I cover it in more detail in another video, mention that at the end, PE multiple contraction or expansion. For anyone who's not sure exactly what that means, here's a quick snapshot. You've seen a share price go from £1 to £1.20. You're looking for the reasons. All right, we've said there are two factors in play here. Earnings growth could be the story, or multiple expansion. How can just multiple expansion be the story? Well, here's how. PE multiple is 10, same facts as before. Earnings per share 10p. 10 times 10 means the share price is £1, if you like. Now, what's happened here? Share price has risen to £1.20, but this time, earnings per share hasn't changed. What has moved is the PE ratio, and mechanically, that has dragged the share price from £1 to £1.20. That's simple and relatively small looking change in the PE ratio. So this time, the share price has been driven higher by expectations changing, multiple expansion in this case. And that's important. It's important to understand that that's going on. So if we were to fill in the gap now on that table I mentioned earlier, so remember what we're trying to do is explain the annual total return across these decades. All right, what we see is the contribution of this third column, the PE multiple change. And you can see here we've got some real volatility. Some decades we've got multiple contraction, all right, like this one here, for example, the negative number. Others we've got multiple expansion. But you can see that's making quite a sizable and quite a changeable contribution to the numbers out on the right. All right, so whatever this is, it's quite powerful. And not understanding it could be costly in terms of understanding shareholder total returns. So, a few observations. All right, first of all, a significant element of the total return is based purely on this thing, expectations changing, the PE multiple contracting or expanding as a result. These moves are heavily sentiment driven. This is the most subjective, arguably, of the three factors. All right, and this can change sometimes on a sixpence. Investors therefore need to fully understand annual returns. Get under the bonnet, in other words, look at how much of the annual total return on average over time is made up of dividend yields, earnings per share growth, and or multiple expansion or contraction. A failure to understand how all three components of driven share prices could be costly in terms of your expectations being met or not met in the future. So that's the main message. Any questions on what is a huge topic? editor@killik.com. If you want to see videos that cover multiple expansion, PE ratios, dividend yields in more detail, because I've flown through them here, then it's killik.com/learn, and your best bet would be the shares tab.